Do you know the secret sauce of Ether Futures ETFs? Hey Chat ETF fam! Welcome back to the channel. Today, we're diving deep into the world of Ether Futures ETFs. You might have heard this term thrown around, but what exactly is it, and is it the right fit for you? Ether Futures ETFs are all about capturing the price movements of Ether, the cryptocurrency that powers the Ethereum network. But unlike buying actual Ether, these ETFs use something called futures contracts. Think of them like agreements to buy Ether at a specific price in the future. So, Ether Futures ETFs offer a regulated way to play the Ether game, but there's more to the story. We'll break down the benefits, the drawbacks, and answer the burning question: can these ETFs give your portfolio a unique edge? Stick around, and by the end of this video, you'll be a full-fledged Ether Futures ETF expert. Let's chat. Question 1. What is Ether Futures ETF? An Ether Futures ETF, exchange-traded fund, is an investment vehicle that provides indirect exposure to the price movements of Ether, ETH, the native cryptocurrency of the Ethereum blockchain. Unlike directly buying Ether, these ETFs do not hold the actual cryptocurrency itself. Instead, they invest in Ether futures contracts. Here's a breakdown of how it works. Futures contracts. These are agreements between two parties to buy or sell an asset at a predetermined price on a specific future date. In the case of Ether Futures ETFs, the underlying asset is Ether. ETF structure. Authorized participants, typically large institutions, create the ETF shares. These shares are then backed by a basket of Ether futures contracts held by the ETF. Tracking Ether price. The ETF aims to track the price movements of Ether by continuously rolling over the expiring futures contracts with new ones closer to the expiry date. Key points. Indirect exposure. Investors in Ether Futures ETFs are not directly owning Ether. They are speculating on the price movements through futures contracts. Regulated environment. Ether Futures ETFs trade on regulated stock exchanges, offering a potentially more familiar and accessible platform for some investors compared to directly dealing with cryptocurrency exchanges. Not perfect tracking. Due to factors like contango, futures prices typically trading higher than the spot price, and roll costs, expenses incurred when rolling over contracts, the ETF's price might not perfectly mirror Ether's price movement. Question 2. What is the Ether Futures ETF's primary investment objective? The primary investment objective of an Ether Futures ETF is capital appreciation, which translates to aiming for an increase in the overall value of the ETF shares over time. Here's a deeper explanation. Focus on price movement. Ether Futures ETFs don't directly invest in Ether itself. Their core purpose is to track the price movements of Ether through the underlying futures contracts. Profiting from price fluctuations, the ETF structure revolves around benefiting from increases in the price of Ether. When the price of Ether goes up, the value of the futures contracts held by the ETF rises as well. This translates to an increase in the net asset value, NAV, of the ETF, ultimately reflected in a higher share price. While capital appreciation is the primary goal, it's crucial to understand the nuances. Indirect exposure. Unlike owning the actual Ether, investors are exposed to price movements through futures contracts. This means the returns might slightly differ due to factors like contango and rolling costs. Focus on long-term growth. The objective is to achieve positive returns over a longer investment horizon. Ether's price is known for high volatility, and short-term fluctuations might not directly translate into the ETF's share price due to the management of futures contracts. Question 3. Does the Ether Futures ETF track a specific index? Yes, Ether Futures ETFs do track a specific index, but with an important distinction. Underlying benchmark. These ETFs aim to track the performance of an index that reflects the prices of Ether futures contracts, not the price of Ether itself. Here's a breakdown. Traditional ETFs typically hold the underlying assets they aim to track, e.g., a stock market ETF holds the actual stocks. Ether Futures ETFs, due to regulatory restrictions and the complexities of directly holding cryptocurrency within an ETF structure, they cannot hold actual Ether. Therefore, they rely on futures contracts as a proxy for tracking Ether's price movements. Specific indices tracked. SPCME Ether Futures Index. This is a common benchmark used by several Ether Futures ETFs. It tracks the price of front-month Ether futures contracts traded on the Chicago Mercantile Exchange, CME. Other potential indices. Some ETFs might track similar indices based on Ether futures contracts traded on other exchanges. Crucial points. Indirect tracking. The ETF tracks the performance of the chosen index, which in turn reflects the movement of Ether futures contracts, not the direct price of Ether. Imperfect correlation. Due to factors like contango, futures prices typically trading higher than the spot price, and roll costs, the ETF's price might not perfectly mirror the movement of the underlying index. Question 4. How frequently does the Ether Futures ETF rebalance its portfolio? Ether Futures ETFs engage in a process called continuous rebalancing to maintain their exposure to Ether's price movements. This rebalancing doesn't involve physically buying or selling Ether, but rather strategically managing the underlying futures contracts within the ETF's portfolio. Here's a detailed explanation. Futures contract expiry. Ether futures contracts have specific expiry dates. Once a contract reaches its expiry, it becomes worthless, and the price movements of that contract no longer reflect the current market value of Ether. Maintaining exposure. To ensure the ETF continues to track Ether's price, it needs to constantly hold futures contracts that are relevant to the current market conditions. Continuous rollover. As contracts approach expiry, the ETF manager strategically sells the expiring contracts and uses the proceeds to purchase new ones with further expiry dates. This process is known as rolling over the futures contracts. Frequency of rolling over. Not fixed schedule. Unlike some traditional ETFs that rebalance at specific intervals, Ether Futures ETFs employ a continuous approach. Monitoring and proactive management. The ETF manager constantly monitors the expiry dates of the futures contracts within the portfolio. Strategic rollover. New futures contracts are typically purchased closer to the expiry of the existing ones, aiming to maintain a relatively constant exposure to the relevant portion of the futures curve. Factors affecting rollover frequency. Market volatility. In periods of high volatility, the ETF manager might need to roll over contracts more frequently to adjust the portfolio's exposure to changing market conditions. Contango. When contango, futures prices trading higher than the spot price, is significant, the manager might delay rolling over to minimize the impact of roll costs on the ETF's performance. Key points. Continuous process. Rebalancing in Ether Futures ETFs happens continuously through rolling over expiring futures contracts. Strategic management. The ETF manager actively monitors and adjusts the portfolio based on market conditions. No fixed schedule. The frequency of rolling over contracts is not predetermined but depends on factors like expiry dates, volatility, and contango. Benefits of continuous rebalancing. Maintains exposure, ensures the ETF remains aligned with its objective of tracking Ether's price movements. Mitigates expiry risk, prevents the portfolio from holding expiring contracts that no longer reflect the current market value. Drawbacks of continuous rebalancing. Roll costs. The process of buying and selling futures contracts incurs trading fees, which can slightly eat into the ETF's returns. Imperfect tracking. Due to contango and timing considerations, the rebalancing process might not perfectly align the ETF's price with the underlying index it tracks. In conclusion, Ether Futures ETFs rely on continuous rebalancing through strategic rolling over of futures contracts to maintain their exposure to Ether's price movements. This approach offers flexibility, but involves ongoing management and potential for tracking imperfections. Question 5. Does the Ether Futures ETF use any leverage or derivatives? Ether Futures ETFs inherently use derivatives, but their leverage usage is a bit more nuanced. Here's a breakdown. Derivatives. Core building block. Ether Futures ETFs rely on futures contracts, which are a type of derivative. These contracts represent an agreement between two parties to buy or sell Ether at a predetermined price on a specific future date. Tracking mechanism. By holding a basket of Ether futures contracts, the ETF aims to track the price movements of Ether indirectly. Leverage. Potential magnification. Futures contracts can introduce an element of leverage. This means that even a small movement in the price of Ether can lead to a larger proportional change in the value of the futures contract. ETF structure. However, Ether futures ETFs themselves don't necessarily use leverage in the traditional sense. They don't borrow money to invest in more futures contracts. Leverage through futures. Implicit leverage. The leverage inherent in futures contracts can be amplified by several factors. Margin requirements. Futures contracts typically require a margin deposit, which is a percentage of the total contract value. This means a smaller upfront investment can control a larger contract value, magnifying potential gains and losses. Multiple contracts. An ETF might hold multiple futures contracts to represent a larger exposure to Ether. This can also amplify the leverage effect. Key points. Derivatives are essential. Ether futures ETFs fundamentally rely on futures contracts, which are derivatives. Leverage from futures. The inherent leverage in futures contracts can magnify the impact of price movements on the ETF's value. No additional leverage. The ETF structure itself typically doesn't employ additional leverage by borrowing money. Comparison to traditional leverage. Active management versus built-in leverage. Unlike a leveraged ETF that might use borrowed funds to amplify returns, the leverage in Ether Futures ETFs is embedded within the futures contracts themselves. In conclusion, Ether Futures ETFs rely on derivatives, futures contracts, as their core investment mechanism. While they don't necessarily use leverage in the traditional sense of borrowing money, the inherent leverage within futures contracts can magnify the impact of price movements on the ETF's value. Question 6. How has the Ether Futures ETF performed in different market conditions? Ether Futures ETFs are a relatively new financial instrument, and their performance history is still developing. However, we can analyze how they might perform in different market conditions based on their underlying structure. Bull market, rising Ether prices. Positive performance. In a bull market where the price of Ether is rising, the ETF would be expected to deliver positive returns. As the value of Ether futures contracts increases, the net asset value, NAV, of the ETF should also rise, reflected in a higher share price. Bear market, falling Ether prices. Negative performance. Conversely, in a bear market where the price of Ether is declining, the ETF would likely experience negative returns. The value of the underlying futures contracts would decrease, leading to a decline in the ETF's NAV and share price. Volatile market. Amplified movements. Due to the inherent leverage embedded in futures contracts, Ether futures ETFs might experience more significant price swings compared to directly holding Ether. Upward volatility. In periods of increasing volatility with sharp price rises, the leverage can magnify gains. Downward volatility, however, during volatile downturns, the leverage can also amplify losses. Contango, futures prices trading higher. Potential drag on performance. Contango refers to a situation where futures prices trade at a premium over the spot price of the underlying asset, Ether in this case. This can negatively impact the ETF's performance in two ways. Rolling costs. When the ETF rolls over expiring contracts for new ones with higher prices, it effectively incurs a cost that can eat into returns. Imperfect tracking. The contango premium can cause the ETF's price to deviate slightly from the actual price movement of Ether. Question 7. What are the key risks associated with the Ether Futures ETFs investment strategy? Ether Futures ETFs offer a way to gain exposure to the cryptocurrency market through a regulated environment, but they come with inherent risks associated with their investment strategy. Here's a breakdown of the key ones. 1. Volatility and price fluctuations. Cryptocurrency market. The cryptocurrency market, including Ether, is known for its high volatility. Prices can experience significant swings in short periods, leading to potentially large gains or losses for ETF investors. Leverage amplification. As discussed earlier, the leverage embedded within futures contracts can amplify these price movements. Even small changes in the price of Ether can translate into larger fluctuations in the ETF's share price. 2. Tracking imperfections. Indirect exposure. Unlike directly owning Ether, these ETFs track the price movements indirectly through futures contracts. This indirect approach can lead to imperfections in how the ETF reflects the actual price of Ether. Contango impact. Contango, where futures prices trade higher than the spot price, can cause the ETF's price to deviate from the actual price movement of Ether. Rolling over expiring contracts at higher prices can also negatively impact performance. 3. Regulatory uncertainty. Evolving landscape. The regulatory landscape surrounding cryptocurrency is still evolving. Changes in regulations could potentially impact the availability or functionality of Ether Futures ETFs in the future. 4. Counterparty risk. Futures contract risk. The value of Ether Futures ETFs ultimately relies on the creditworthiness of the counterparties to the futures contracts held by the ETF. If a counterparty defaults, the ETF could experience losses. 5. Management fees. Operational costs. Ether Futures ETFs typically have expense ratios associated with managing the fund and overseeing the rolling over of futures contracts. These fees can eat into the overall returns for investors. 6. Liquidity risk. Emerging market. The Ether futures market is still relatively young compared to traditional financial markets. There's a risk of lower liquidity, which could make it difficult to buy or sell ETF shares at the desired price, especially during periods of high volatility. 7. Cybersecurity threats. Digital assets. Since Ether futures ETFs deal with cryptocurrency derivatives, they are susceptible to cybersecurity threats. Hacking incidents could potentially lead to losses for the ETF and its investors.